Great pick. This topic hits perfectly because every viewer thinks the stock market is for rich people. That myth-bust angle will keep them watching till the end. Writing your full 11 Labs ready script now. Let me paint you a picture. Two people. Same age, same city, same salary. One of them puts a small amount of money into the stock market every single month and forgets about it. The other keeps their money in a savings account because the stock market feels scary, complicated, and honestly, like something only rich people do. 25 years later, one of them retires comfortably. The other is still working. Same starting point, completely different ending. And the only difference was one decision. Today we are asking the question that most people are too afraid to ask out loud. Does the stock market actually work for normal people? Not for Wall Street traders. Not for hedge fund managers. Not for people with millions sitting around. For regular people. People with a normal salary, normal expenses, and maybe a few $100s or rupees left over at the end of the month. Let's find out. First, what even is the stock market, and why does everyone act like it's so complicated? At its core, the stock market is just a place where you can buy a tiny piece of a company. When you buy a share of a company, you become a part owner of that business. If the business grows and makes more money, your share becomes more valuable. If the business struggles, your share loses value. That's it. That's the whole thing. The complexity people talk about. The charts, the technical analysis, the trading strategies, that's a layer on top that you as a normal person do not need to touch. You don't need to predict which stock will go up tomorrow. You don't need to watch the market every day. You don't need a finance degree. The basic version of stock market investing is genuinely simple and genuinely available to anyone. So why do normal people think it's not for them? There are three big reasons, and all three are worth addressing directly. Reason 1. They think you need a lot of money to start. This is one of the most persistent myths in personal finance, and it is completely false. 20 years ago, this had some truth to it. Buying stocks required going through a broker, paying commissions, and usually investing in large chunks. But today, you can start with literally $10. Many investment apps and platforms allow fractional share investing, meaning if one share of a company costs $500, you can buy 1/10 of that share for $50. The barrier to entry has never been lower in the history of financial markets. You do not need thousands of dollars to begin. You need consistency, not a large sum. Reason 2. They think it's gambling. This one is understandable because on the surface, investing and gambling look similar. You put money in. You might get more back. You might lose it. But the comparison falls apart when you look at the data. Gambling is a zero-sum game. For every winner, there is a loser. The house always has an edge. Over time, gamblers lose. The stock market is fundamentally different. When you invest in stocks, you are investing in real businesses that produce real products, employ real people, and generate real profits. Over time, as economies grow, as companies innovate, as populations increase, the value of those businesses tends to grow. The stock market has gone up and down every single year. Crashes happen, recessions happen, but zoom out and look at the last 50 years, and the trend is unmistakably upward. The S&P 500, an index of the 500 largest American companies, has returned an average of roughly 10% per year over the last century. No single year is guaranteed. But the long-term trend is clear. Reason 3. They tried it once, lost money, and never went back. This one is painful because it happens to so many people. They hear about a hot stock. They put some money in. The price drops. They panic and sell. They lose money and conclude that the stock market is a scam. But here's what actually happened. They weren't investing, they were speculating. They were trying to time the market, pick the right stock at the right moment, and get out before things went wrong. That approach fails even for professionals. The strategy that actually works for normal people looks nothing like that. So what does actually work? Let's talk about index fund investing, because this is the strategy that changed everything for ordinary people. An index fund is a type of investment that doesn't try to pick the best stocks. Instead, it buys a tiny piece of every major company in the market. When you invest in an S&P 500 index fund, you are automatically invested in Apple, Microsoft, Amazon, Google, and hundreds of other companies, all at once, with a single purchase. You don't need to research individual companies. You don't need to guess which sector will perform best. You just buy the whole market and hold it. And the results speak for themselves. If a normal person had invested just $200 a month into an S&P 500 index fund starting in 1995 and never touched it, no panic selling, no market timing, just consistent monthly contributions, by 2025, they would have contributed $72,000 of their own money. But their portfolio would be worth well over $400,000. The difference between what they put in and what they ended up with, that's the stock market working for a normal person. This is the power of compound growth. Your money earns returns. Those returns get reinvested. Then those reinvested returns earn their own returns. And the cycle keeps going, getting bigger every year. It starts slow, almost invisibly slow, but after 10, 15, 20 years, it becomes something extraordinary. Now let's be honest about the risks, because pretending the stock market is risk-free would be lying to you. And that's not what this channel is about. The stock market goes down. Sometimes a lot. In 2008, markets crashed by nearly 50%. In March 2020, they dropped 30% in a matter of weeks. If you had invested your life savings right before either of those crashes, you would have watched your portfolio cut in half almost overnight. That is a real, terrifying, stomach-dropping experience. And if you had panicked and sold at that moment, you would have locked in those losses permanently. But here's what happened to the people who didn't panic. The people who kept their money invested, kept their monthly contributions going, and waited. By 2013, markets had fully recovered from 2008 and gone higher. By late 2020, markets had fully recovered from the COVID crash and hit new all-time highs. The crash felt like the end. It wasn't. It never was. This is the single most important thing to understand about stock market investing for normal people. Time in the market beats timing the market. Every single time. The risk of the stock market is not that it goes down. The risk is that you panic when it goes down and sell before it comes back up. The people who get hurt are the people who treat a long-term investment like a short-term trade. So what does this mean practically? It means the stock market is not for money you need next month. It's not for your rent money or your emergency fund. It's for money that you genuinely don't need for at least 5 years, ideally 10 or more. That time horizon is what transforms a volatile, scary graph into one of the most reliable wealth-building tools in human history. Let's bring this back to the original question. Does the stock market actually work for normal people? The answer is yes. Unambiguously, historically, provably, yes, but with conditions. It works for normal people who start early, even with small amounts. It works for people who invest consistently every month, regardless of what the market is doing. It works for people who buy broadly diversified index funds rather than trying to pick individual stocks. It works for people who have a long time horizon and the emotional discipline to not sell when things look scary and it does not work, or at least massively underperforms, for people who try to time it, chase hot stocks, or treat it like a get-rich-quick machine. The stock market is not a lottery. It's not a casino. It's not a club for the wealthy. It is a long game. And normal people who play the long game win it. You don't need to be rich to start investing. You need to start investing to eventually become rich. That's the whole secret. And now you know it. If this video opened your eyes, subscribe to Money Habits, because this is exactly what we do here. We take the financial concepts that feel complicated and intimidating, and we break them down until they make sense for real people living real lives. Like this video if it helped. Comment below. Are you already investing, or is this the video that's finally going to make you start? I want to know. See you in the next one.